All right. So our discussion for today is navigating to the new era of mutual fund distribution and wealth creation. I think it's a very opportune time to be talking of wealth creation and mutual funds, given the way that the markets have been performing. But more significantly, I think the way that domestic mutual fund investors, both retail and institutional, the way they have been participating in the rally, that is very, very crucial. So they have in fact surpassed the foreign institutional investors. Each day, every month, there are new records being set for the SIP accounts, for the folio accounts. In August, SIP accounts were 9.65 crore. The folio accounts surpassed 20 crore. So my question to the experts is, what has enthused the domestic mutual fund investors? What are the factors that have contributed to their participation with such fervor? Maybe I can start with Mr. Vishal Kapoor, if you'd like to answer this.
Thanks, Riju. And I think, firstly, fabulous to be here to meet many old friends, and for everyone who's over here, congratulations. I think coming back to this forum, which is getting bigger and bigger every year, is a straight, I think, visual, almost confirmation of how our industry is doing. And I think the answer really, Riju, lies with them, which is, these are the stalwarts who've made this phenomenon happen. And I think most of you will probably look back and say that this is not really such a recent phenomenon. The roots for many of the things, the fruits that we're seeing today may have been laid several years back. And I know many of our friends here have been doing some very persistent, very diligent, very almost, just back-breaking work for many years. In one way, what we may be seeing really right now is the J curve or the S curve. And with any exponential curve, now we are beginning to notice it a lot more. A lot of the growth as we see today is very granular. I think we should feel happy about that. If you look at net sales, the proportion of net sales that is coming through SIPs now is a story in itself, which tells us that this is not really just hot money or lump sum money. We cannot negate that part. Of course, any market which has momentum will have portions of hot money coming in as well. But if you look at the balance, the way the SIP story in India has grown, the average being just a few thousand rupees, tells you about how this is really a lot more structural than just being a recent phenomenon. And for that, I think we can probably spend many hours discussing what has led to that. Whether it's a combination of just growing awareness, thanks to media as well, but also a lot of hard work put in by the distribution fraternity to get new customers into the fold, to get them through cycles so that they're not ejecting from the cycle every time something turns, and just handhold and keep them there and have faith in the markets. And now a growing population of successful investors, in the sense that who've gone through a cycle, have seen wealth generate, and therefore are willing to put more and more of their financial assets into mutual funds.
Mr. Kumar, this is for you. Do you think that this India growth story, the way the markets have been soaring, that has also had a... Hello? Yeah, all right. So this was for Mr. Gopkumar. What I want to add to those factors is, do you think that the India growth story that has been playing for some time now, and the soaring markets, they have also somehow enthused the investors, to mutual fund investors, to come in now?
Yeah, I think true. Generally, when you see these type of markets, we had a couple of cycles, right? A couple of cycles you've seen.
Could you please speak up a bit? Yeah.
Now I'm okay? Okay. In a couple of cycles, you've seen that new set of investors coming, and you also seen that markets are going down, specifically 2008. You would have a situation in 2014. You've seen that customers also running away from the markets. Certainly, I see there is a very structural change. What is different this time compared to 2008 and 2014 is the way the investors are looking at the equity as a class or a mutual fund as a product. there is a point I want to make is that India now doesn't have savers. India has substantial portion of investing community become investors. So the first product what a customer is looking at is not FDs. In our days, I think we all have done the first FDs. I think the first investment is mutual fund. That's the change happening. That is a very structural change in terms of how the investors are looking at mutual funds. Second important point also I'm seeing is that the traditional investments which people had put, like bonds, you have Kisan Vikas Patra, you have post office savings. There are a lot of instruments the government of India had put. All these are getting matured. And where the money is going, the money is coming back to the mutual fund industry. I think that is what I want to tell you is that complete structural changes happened. Obviously, there is a word called aspiration. Indians have become much more aspirational. We can see here our friends are much more aspirational what they were maybe 5 years back. I think Vishal should know about this. Maybe 10 years back, you would have serviced a similar set of people. Today, they don't talk less than 100 crores a year. And I was other side of the table when I started my career. I was advisor. I was in private wealth. For us, that time in RM, managing 50 crores means he's a big man. Today, I think at a 50 crores, I think nobody even look at him. I think that type of wealth has been created, and that is the type of wealth that people manage today. I think, in my point of view, is that it's much more structural compared to all the 3 or 4 cycles which I have seen.
All right. Okay, before we proceed any further, I'd like to inform the audience that we have some questions for you as well. You can use the QR codes to answer those questions, and then maybe we can discuss those. So maybe I'd like to, the first question that I'd like to ask everybody is, how long do you think the current market rally is going to last? Less than a year, more than a year? So you can, is the question up on the screen? All right. I think you can do that. All right, that is a different question. What level do you see markets? All right, I think you can go ahead and answer that question. That's perfectly fine. All right, and in the meanwhile, maybe we can move to the other questions. We can have the discussion flowing now. Okay, so we were talking about wealth creation, as Mr. Gopkumar also said, and the structural change. The wealth, when we talk of wealth creation, as he said, historically, Indian investors have favored, say, fixed deposits, as he said, but also in a lot of ways, the traditional insurance plans, the LIC plans. I think everybody had LIC plans as an investment instrument in their portfolios. But now we are seeing this gradual shift to mutual funds. So what I'd like to ask Mr. Mahesh Patil maybe is, what will it take for mutual funds to be the first investment choice, the top investment choice for the Indian investors?
Yeah, hello everyone, and thank you for this question. So I think if you look at what has really happened in the last few years, I mean, typically Indian investors, they were wary about investing into equity as an asset class. They always thought it was risky. Okay, which is risky? We know equity is volatile. But I think over a period of time, I think the realization has come in that while it is risky, but really if you want to create long-term wealth, then that's the only asset class which can actually give you returns which are significantly above the inflation, right? And more so, I think the mutual fund industry has been able to build that trust, because that was the most important factor for investors who wanted to come into the equity markets. And I think the mutual fund platform, okay, with the investor education programs which have done along with AMFI, and even the regulator, okay, what it has done in terms of bringing in transparency across, I think that has really helped for investors to really start trusting, because once you get that trust, why did people go into insurance, right? The products from the insurance, and because they knew they will get around whatever 6-7% kind of a return, fixed return, right? Now whether the return was good enough for them to really take care of their financial needs and their financial goals, probably not. but at least the comfort was there. I think that same trust as the mutual fund industry and the fraternity, okay, gets that from investors, I think you will see more and more money coming into the mutual fund side. And and again, the mutual fund platform has matured quite a bit in terms of the number of products, okay, which are there. There's a specific product for every particular customer for his risk profile, right? We have across the spectrum, right, from arbitrage funds, if you look at it, right? I mean, fixed income products are anyways been there. But even on the equity side, okay, we have arbitrage, then we have the balance advantage funds, we have the hybrid funds, large cap, mid cap, the thematic funds. So I think there is everything for any particular investor he wants to choose as per risk profile to manage his financial goals. And so I think given the fact that this is just a beginning in a way, right? Because what we have seen in the last 3 years, while the overall mutual fund industry in terms of the number of folios, they have doubled, but it is still very low, right? If you look at the total penetration for mutual fund industry, okay, would still be in the high single digits, right? So I think there is a long way to go. And as even the younger generation, now probably I think the young generations who are coming into the market, I think because of their risk appetite is much higher, right? So they are coming either into the directly stock markets first, and we have seen that people who are trying to speculate in the market, over a period of time they realize that's not a place, right? Because the statistics shows us that investors who are coming in for trading, and that's where the first appeal comes in, right? To make short-term money into the markets. They haven't made returns. The recent statistics by SEBI which came in says that 93% of the investors, okay, who are speculating in the market, they have lost money. But they are the first investors who actually come into the market, and then they realize, okay, mutual fund is probably a way, okay, where if they really want to create long-term wealth, and because they want to move away from the traditional asset class, right? So historically, if you look at our household savings, they have been largely, if you look at 60% is still into physical assets, right? Which is real estate and gold. And on the financial side, it is fixed deposit, and as you rightly said, insurance and other endowment products which are there. And I think slowly, the risk appetite and the trust factor which the industry has gained, I think you will see that transition happening. And I think the way investors are coming in, right, systematically, okay, through various options, I think the ease of doing business and the SIP, I think as a route, is able to tackle the volatility, right? The risk part, okay, which is there, right? So that has been taken care of, and I think this trend, I think, should continue. I think soon the mutual fund industry, if you look at equity ownership as a percentage of household savings, which is still around just about 5.5–6% only, right? Whereas, as you said, insurance or the endowment products is around 10–11%. My sense is that is, the way it is going, I think it is not far whether it will overtake the insurance industry in terms of the products.
All right, that's good to know. Vinay, if you would want to add anything to that, any advice to the investors as far as wealth creation is concerned, of course, with focus on mutual funds?
Am I audible? Yeah. Thank you for that question. So I think this is just an extension of why mutual funds and generally equities have become very popular. Just taking off from the previous question as well, mutual funds are far more transparent and clearly extremely attractively priced for investors, and given the spread of financial education, people like our audience who are here, financial advisors who are clearly incentivized to work for their investors, all of these people definitely favor transparent products which are which do not involve material intermediation expenses, and of course products which can satisfy the needs of various types of needs of the investors. So I think per se mutual funds have a lot of things going in for them. Apart from that, purely from advice for investors, I think one of the reasons why, in fact, there are a few reasons why mutual funds and in fact generally equities have taken off. It was, if we remember that post-COVID, a lot of people were at home, they did not know what to do. And the only thing which was moving, which was exciting, was the stock market, right? It was appearing lively. Everything all around was very gloomy. So most people at home thought what to do, and at that point of time, the number of trading accounts zoomed, number of investors as well zoomed, and post that, what we saw is the markets have delivered continuously a sustained positive returns, and that has added fuel to fire. More investors have joined in, and hence I think this has been a virtuous cycle of more and more investors looking at positive returns and investing in the market. So much so that now the investor expectations have gone up significantly. So my first advice is, first and foremost, we have borrowed some returns from the future at this point of time, make no mistake. So we have to moderate our investors' return expectations. Very difficult task, but people all in this audience, I'm sure they are well educated enough. So they need to moderate return expectations, and of course encourage investors to stay invested over a longer period of time. So I think those were two things which I would want to highlight.
Staying invested for a long period of time, that is, I think that advice works for all seasons. I think I'd like to go on a tangent here for something that Mahesh said, that SEBI's report says that I think 91% of individual investors, they are losing money in derivatives. So when we talk about investors coming to the market, domestic investor, retail investors coming to the market, do you think that this is a big risk right now that is posed to the individual investors who are getting into derivatives, who are very enthused by the market, but at the same time they are not realizing the risks that they are entailing? Mahesh, would you want to answer that?
Yes, I think so. I think the last few years markets have been on steroids. I mean, it's been for first-time investors who have come into the market, and see many investors who have come in for the first time. That's shown by the demat accounts, right? They have doubled in the last 3 years. So clearly all these investors are, 50% of the investors who are there are new, right? And they haven't seen a correction in the market, right? So one is talking about dabbling into derivatives, that's a different aspect altogether. But one is really investors who are coming into the market, probably some speculation, okay, but also trying to come long in the market. I think they haven't seen a correction. So clearly I think they are chasing returns sometimes, looking at stocks, okay, past returns, and we've seen that exuberance in a certain pockets of the market. So I think clearly there is a cause of worry over there. But for investors who are coming for trading, right, if you look at the F&O segment, right, which is there, or the futures and options, which has drawn a lot of kind of interest, and even the regulator has been worried about that because that is something which is, we've seen the volumes over there, right? Indian volume in India in the F&O segment is now actually equal to in the US market, right? And as you know, US market is many times bigger than our markets. And I think that is something which is clearly a cause for worry, because we want to inculcate a habit of long-term investing, right, which is there. So I think while the efforts are being there, okay, in terms of educating, and a lot of these reports which are coming in and warnings is to tell investors that this is not the way to create long-term wealth, right? And I think that realization, I think, will slowly creep in. And I think those investors would move into the mutual fund route. But I think that's a segment, I think, where now I think the new guidelines, okay, which will come in, right, in terms of the futures and options, okay, market, where the intervals will be curtailed over there. I think that will probably put some kind of a curb in terms of the volumes, what we are seeing in that segment.
All right. Gopkumar, would you want to add to that?
Yeah, my last assignment before coming to MC was running a brokerage firm. So I ran retail brokerage firm for almost 15 years. I always tell that future mein future nahi hai, option mein option nahi hai. I think this is the right thing what you need to think about. That is a worry. When I look at any data point, today regulator has put the data point outside and said 91% loses money. I think this was been there for last 10 years. I have seen the first contract in 2008 when the contract came in, and the days were different. today my worry is that very young investors coming in, very, very young investor coming with the average age for an F&O customer is not more than 32 years. And if he takes the first product, a financial product as an F&O as a product, I think there is a real issue here. 5 months back, we released a report on F&O. Ashish Gupta released a report on F&O. It got the hold of ministry, and a lot of work is happening now. I think we'll find new regulation coming around. How do you discourage F&O? I think that is one. Second, on the point on insurance, my point is that insurance is required. I'm not batting against the insurance as a product. And a financial planning, the first case is that you require insurance. There's nothing wrong about it. Where there's an advantage versus mutual fund is that it is a locked-in product. The behavior of the customer becomes because he clearly knows that I can't take the money for 5 years or 10 or 20 years. I think, so the life of insurance advisors makes much more easier compared to a mutual fund advisor. I think that's a point I want to make in terms of looking at. So I think broadly, yes, people lose money in F&O. Some people come back. I have seen people coming back. I had one data when we saw was 90% losers first month, and they come back. On a third month, 100% of people change. That's what we used to define. And we used to define simple is that 9 o'clock market opens, 9:15. It's like a kirana shop. You don't know who comes to buy stocks. But I know who comes every day is a customer who's an F&O customer. But I know he buys cigarettes. I know one day he'll die. So we typically used to look at analytics and say that, okay, this customer has not come back. Just call up. We clearly know that this customer has lost money. And they don't come back at all. Okay. And that's the problem. I think regulator is addressing, ministry is addressing. I think all the industry bodies also looking at it. I think we should have some solution around this.
All right. Okay, Vinay, I think Mahesh or Gopkumar, they mentioned that young investors, that is a bit of a tricky area because they have not seen any correction. So do you have any advice for the young investors who are getting into the markets, getting into the mutual funds right now?
Yeah, just don't look at YouTube videos as do-it-yourself trade strategies and make it a video game. Investing is serious business. It involves your hard-earned money. And I think if young investors are entering and they make some losses, it's good if they make some losses because it's a small tuition fees, which they will pay at the start of their careers. And I think over a longer period of time, they will come back as great long-term investors. I think all of us would have paid tuition fees like this at some point of time in our lives. And I think it's only once you pay this tuition fee, will you realize no amount of coaching or prodding or a regulator coming out and talking to you will make a difference. Unless and until you are cleaned out, you will not understand. So I think that's what is going to happen.
All right. Vishal, I'd like to ask you this. So when we talk of wealth creation and we are focusing on mutual funds, so mutual fund distributors, what kind of role going ahead can they play to encourage the domestic investors further to coming into the mutual funds?
Okay, so maybe, yeah, maybe I can start with what is the role ahead that is not going to be enough if we were to look ahead.
Sure, sure.
And in some ways, and having been a mutual fund distributor in my part life, I think for many of us, you'll relate that life in the past was much easier in many ways. Because with low levels of awareness that most investors had, telling them about mutual funds, a long list of bullet points on why mutual funds are better, they're efficient, and they are very low cost, and they've got great performance track record, regulated, trust, all of this was good. And then helping them through some, KYC, form filling, product selection was, mostly transaction done. And once in a while, we had to go and, give them a statement or take care of some service issues, and pretty much, हो गया, दाल चावल निकल आएगा इससे. And a lot of the focus used to be about acquiring new investors, because the first leg of getting new customers through the initial concept selling and education was the largest part of where we added value as a distributor. I think today, if we look at it, that landscape is clearly shifting. So no longer is so much effort required in acquiring the customer through concept selling, because the concept is getting very well understood by the investor. And actually, when you look at some of the data coming in, 30–40% of investors are not even meeting someone to buy their first mutual fund, because they're going straight to a fintech platform and buying it. So if it's so easy to buy the first product, then clearly our role as an MFD to concept sell the mutual fund and do the first 2 bits is almost gone. KYC again, few clicks, it's done. Servicing, actually a fintech platform will give you all sorts of performance reports that individually we'll suffer to get. So really the question has to be, where will we add value going forward? And unless we are realigning ourselves to providing that additional value, will we still be relevant 10 years down the line? I think that's an important question for us to ask ourselves. Now, there is a huge amount of scope still, because I think anyone who's in this room will recognize that the value we add is in the hand-holding, in terms of the behavior that customers display, especially when things are volatile. So right now, when the market is unidirectional, sometimes it can make us think that, okay, what really am I doing? Because anything you touch is turning into gold. But the basic essence of a market is volatility. Things will turn. And when things turn, I think that's where the true value of a good distributor, advisor, guide comes to fore. And that's where I think people who are in the room can play a meaningful role, much more meaningful than a faceless transaction-based service, in a sense. So I think the future really is in adding value through deeper knowledge, better understanding of the customer that leads to better behavior for the investor. And one of the reasons I'm saying this is because even today, while we've had such a stellar run in the mutual fund industry, anyone here who's tried to sell an equity fund with a less than 3-year time horizon? Anyone? I think all of us will say कि equity में जा रहे हो तो at least 3 साल, 5 साल, 7 साल, 8 साल, that's it, right? Yet, the average holding period of an equity mutual fund in our industry is about 2 years. So there is a huge gap between behavior and potential. How many of us have investors who have stayed true to an SIP for 20 years, 25 years? And why is 20, 25 years important? Because I think as an Indian, all of us at some stage have aspired to become a crorepati, all of us. Right? Had you put a 10,000 rupee SIP 25 years back in an index in India, you would be more than a crorepati. You would be a 2 crorepati in a sense, right? So wealth opportunity is enormous in our country. We are blessed to be here. We are blessed to be in a phase where things are growing so well, so rapidly. Yet I think our collective responsibility is how do we get more and more investors to actually benefit, participate in that wealth. And clearly some of the data today says that a lot more can be done in that area. And that's where I think we can all add a lot of value.
All right. So 2 years, you say, is what equity fund investors stay in. I think the biggest attraction of the traditional endowment plans in insurance, which is why they were such a favorite, was that disciplined investing, where they continue to invest regardless of any the environmental, the macro factors, they continue to invest in that. So do you think this is the biggest challenge that the mutual fund distributors will face in the future, retaining the investors?
No, so sorry if I may. I don't think, sorry. So the data, as we know, the averages can be very misleading. So the average investor being 2 years, I can almost guarantee that the average investor for this group here will be staying much longer. Can I take that as a yes? most of your investors will be far more longer term in equity.
That is not a very encouraging response, I must say.
I think they're silent and saying, yes,
Okay.
that's a given.
Sure.
Why even bother to answer,
Sure.
right?
Hmm.
Everyone has average equity holding of more than 2 years, I hope. I hope I'm not wrong in this, right? Yes.
Okay,
Okay.
that's more like it.
Right. So one feedback is that maybe a lot of the newcomers, I think Vinay talked about
Correct.
tuition fees. So maybe part of this
Correct.
tuition fee is the very short-term, trading mentality.
Correct.
Maybe that is changing the averages. Maybe that's happening. But I wouldn't equate an asset class which is largely equity and, like Mahesh said, has a proven track record of beating inflation and available at a really marginal cost, highly efficient, with a locked-in product which is largely fixed income, which really doesn't have a great amount of history to beat inflation and therefore generate wealth over a long period of time. So a lock-in being the best way to keep people invested, I don't know if that's the best approach. I do think that awareness and people understanding and a positive cycle, which is what we are seeing now, once you've gone through this tuition fee, once you've gone through this cycle and you realize the benefit of compounding and it hits you and says, okay, this is where I really made a lot of money.
Right.
I think that is what would be a far more almost democratic way to get people to participate. I think, there was a survey recently I saw. So clearly, I think, Gop mentioned earlier when we all joined our workplace, many of us here would have been offered the day you land up in office in a corporate environment, apart from your bank account, an LIC agent will come and sit on your desk saying, now you're responsible, you have to take care of life in a different way, so aap pehle policy kara lo, and you feel very good about it, right? All of us felt good ki chalo kuch responsible kiya hai, right? Today I saw a survey which says, not today, as in a few days back, I saw a survey which says that 82% of newcomers today in the workforce, when asked what will be your first financial product, they said a mutual fund. So that shift is already happening. I think that is already happening. How they will participate in the mutual fund, what channel they use, how they go through the learning curve, that is to be seen. But I do think that the change is happening.
All right.
The averages can be misleading.
Sure.
Just let me
Mahesh.
add to what
Yes.
Vishal is saying. I think the approach to increase the investment horizon, right? I mean, to get long-term, I think we want investors to come in and stay put over there, right? And that's where wealth gets created. I mean, many times we see that investors, while we show the returns, right, for our funds, 20-year returns, whatever, this is the return of 25 years, but investors say that their experience is not, they haven't earned that return. That is because they have come and gone at various points in time in the market, right? And that's, the experience is not good. So how do we really ensure that they stay with us? So I think that's where I think you need to go towards a goal-oriented approach or a solution-oriented approach, right? So looking at a portfolio approach rather than a selling a product, right? Selling a particular scheme. Because if you do that, invariably you will start comparing, okay, and that particular scheme will have its own cycle. It could be a thematic. But if you really go towards a goal-oriented approach, a solution-oriented approach, and do a portfolio approach, then I think the overall experience of the investor, okay, will be much better, right? Because then you're trying to diversify that across various products, and you're looking at a portfolio. You'll have a mix of some thematics. You would have some large cap, mid caps. You will have some fixed income. You would have gold, right? And at a portfolio level, okay, then the returns, okay, will be reasoned and the volatility will be much lower. And then I think the customer would be there for a longer period of time, right? So that's, I think, an approach, I think, which people have started to do that, but that's the way to really retain the customer and stay invested for a long period of time.
Gop Kumar, would you like to add to that? What are the other challenges that mutual fund distributors are likely to face?
I think I agree with Vishal's that average is to 2.5. I think it is getting skewed because of fintech platforms and some extent the private banks. I think that is getting skewed. I saw some number because I just came from the industry, so I had to see this data. I think MFD has a double the size in terms of the average holding period. It's almost 4.6. That's the data. What I saw the data. I think in that sense, another bigger challenge is that we as MFD distributor communities has to adopt technology. I think our problem here is that we don't acquire as much customers possible. I think idea is to think about how do we acquire customers with help of a technology. It makes a lot of sense. And how do you improve the customer interface? Because more and more customers are demanding in terms of services. How do you cater a large number of customers? I think these are the things what you need to think about when you look and say that how do I scale up my business? I think these are a couple of challenges in front. I think a lot of people have found some solutions because there are some great platforms which has come in play. But I think there is still an opportunity for us to improve in terms of how do you service customers much better, because most of the customers tend to ask for a physical meetings, and it becomes impossible when you handle large set of customers. I think that solution exists with the technology and digital. I think as early we adopt, we'll be able to service large number of customers, and so your business can grow much faster. The last point I agree with Vinay is that we need to approach customers not from a product-centric perspective. How do you look at financial planning? How do you do asset allocation? It's very, very important process. I think somewhere in the urgency to sell products, I think we missed that overall goal of helping the customer in terms of achieving the financial goal. I think these are the minuses. I thought I should talk a bit of minuses, that what we need to improve as a community. I think that's where we are.
All right. I think Vishal mentioned this, how the mutual fund distribution scape has changed radically over the years. There was a time when you had to actually go to the AMC office, fill up a form, then give a check, then wait for the SIPs to... Today, this is an instant kind of an investment. Do you think there are some kind of missteps or risks, I wouldn't go so far as to say risks, but wrong decisions that are likely to entail because of this ease of access that the digitization and the fintech options, the online platforms that they are now providing the investors?
So yeah, at the risk of again generalizing, I would say yes. There are clear risks, and I think that data is also beginning to show us, or has been showing us for some time. So behavior that we see of some of the do-it-yourself customers versus the guided, distributed customers is significantly different. And I think, therefore, the concept that, and we discussed FNO earlier, and I would, maybe offer that, look, we shouldn't even equate FNO as an investment product. It's a speculative product.
Absolutely.
It was originally meant to manage risk. It's a hedging product originally, right?
Correct.
Now we've taken that, made it into, how can a 1 month contract be an investment in a sense almost, right? So there are savers, there are investors, and there are speculators. So let's not mix the speculators with the investors. Now in the data, there is maybe a bit of this speculative behavior, trying to make a quick buck also flowing through, and that is clearly the concern that we should have. Part of that market may be, as long as it is relatively small and it doesn't do too much damage, like Vinay mentioned earlier, maybe that is tuition fee. We jumped in without understanding, and like with anything that we have to learn, if I start learning a bicycle, I'll fall down a few times. Hopefully it'll just be a few scratches and not more. So I'm hopeful that, the good thing also, as in just to not reflect on the issue, the risk is there, but the opportunity also for everyone in the room is that KYC is done, because this person's come in, all the paperwork, all of that is already done. So it's available to you and all of us as a potential investor in the future without any friction, without any additional requirements. The second is, this investor or speculator turned investor is likely to have gone through this learning phase, and therefore by the time he or she approaches you for some long-term guidance, they are actually far more seasoned. The expectations are a lot more normal, moderate, and therefore can be a very good long-term investor for you in the long term, provided one is able to cater to them. I think that is a huge opportunity. So while there are risks in what is happening with a lot of DIY behavior, sometimes also fueled by very easy to understand videos, which may not be technically completely, let's say whole in terms of understanding. Sometimes it can be a bit of, leading you to believe something is so simple when it's actually not.
True.
But I think once you go through this cycle, there is still going to be a lot of opportunity that gets thrown into this room for you to take up. And that is, I think, a clear upside we should also look at along with the risks.
Vinay, you'd like to add?
Just wanted to add, uh, you just asked a question on why people stay longer in insurance versus mutual fund. So what is a boon for mutual fund is also a bane. You get daily NAVs. You don't get daily NAVs for your insurance or real estate. You get locked in your real estate or insurance, but you don't get locked in your mutual fund. After 15 days or 1 month, there's no load, or sometimes even no load for most funds today. So while it is a great tool, it's a boon, but at the same point of time, all of this ease of doing business has also resulted in people engage in a very, very short-term behavior, looking at one-day returns, 1 month returns, 1 week returns, doing technical analysis on NAVs. I think those are some of the challenges which, of course, come along with all the good things which are coming in with mutual funds.
All right. Okay, I think somebody here mentioned the role of YouTube videos. Maybe I'd like to put in a question here about the role that the influencers are playing also. Do you think that there need to be stricter guidelines, although SEBI has been trying, do there need to be stricter guidelines for investors' benefit as far as the free advice that is being met out?
So I think most of people like us, we can't talk, right? We have been gagged for most of the times about what things we can talk about, what we can't. And because of that, there is a vacuum. And of course, it is being filled up by both qualified as well as unqualified people. So a lot of people in this room, I am sure, they are making educational videos. They are educating their clients in the right manner, right? And not gamifying it, not making it, or not, I would say, at the extreme end, deceiving the investors such that they make it believe that investments are products which can earn extremely high rates of return for a long period, etc., etc. I think some of these influencers are also generating a lot of greed. And if they are feeding on that greed, I think that is what should be stopped. You can't, and the challenge with that is that with every good thing, there are bad actors as well. So if you try to completely ban or regulate everything, who guides the investors? So I think there needs to be a nuanced approach. I'm not on the regulation side, so I don't know how to do that. But I think you can't just gag everyone, you can't stop everyone, but of course try to regulate entities and individuals who are just feeding on the greed of people and maybe miseducating them.
All right. I think as long as we are talking of wealth creation, we cannot miss out on the current India growth story and the way that the markets are performing, especially now after the much awaited US Fed rate cuts. The markets are suddenly, they have become very excited. And so what I'd like to ask is, given the extremely stretched valuations but the strong fundamentals, where are the Indian markets headed? Is this rally likely to continue? Another important question is RBI likely to introduce the rate cuts in October, or will it be pushed? Mahesh?
Yeah. So I think there is no doubt that, markets had a very good run, right, in the last 3 years or post-COVID. And that makes us wonder that whether this is the top. And many people feel that the market is overvalued over here, right? And there are signs of caution, okay, which have been talked about it. But if you really look at it, right, the market has gone up. But, okay, just take an example. For example, if you look at the Nifty, which is the large cap, right, which is the top 50 companies. So if you look at the earnings growth, right, in the last 5 years from FY19 till now, I think market has gone in line with that, right? If you look at Nifty earnings growth in the last 5 years, right, and the market returns, they are more or less similar. It is slightly higher than that. So actually, it is not, it is to some extent driven by fundamentals also. Why, having said that, if you look at the broader market, right, the story is a bit different, right? When you look at the broader market in the sense, the mid-cap and small-cap segment in that sense, so there the returns have been almost 50% higher than the earnings growth which has been there. So clearly there is a pocket, okay, where a lot of money has chased the stocks because of illiquidity we have seen moving ahead of fundamentals. But broadly I would say that, see, why should you be bullish or bearish on a market, right? The fundamental reason is that the economy, right? Because if the economy does well, the corporate earnings will grow. If corporate earnings do well, markets or the stocks will do well, right? So for us to really decide whether this is the peak or whether one should be exiting over here, one has to answer a question is that, are we seeing the economic growth sustaining from here going forward, right? And if you ask me, the answer to that question is that we believe so, right? Because we are now, I think the whole foundation, okay, which has been led, okay, for this economy and the reforms what we have seen, I think we see a much more sustainable growth for the economy going forward. It might not be a very high growth rate like what we saw in the earlier bull markets, but the economy can continue to grow at around 6.5% or so, 7% in that range. And there are multiple factors, right? One is, for the first time we are seeing now investments, right, which were kind of lagging in the last pre-COVID investment cycle was down. We've seen that now pick up and the overall investment to GDP ratio is steadily moving up. Initially it was led by the government support. Now the shift is happening toward the private sector, right, CapEx, which will now take the shift from here. And as you know, when it is led by investments, okay, that is much more longer term and sustainable in nature. And I think more importantly, I would say that the macro stability, right, which India has achieved now, I think I haven't seen that, right? So what do you mean by macro stability, right? I mean, in terms of volatility, right? So if you look at a currency, right, it's the most important this thing where everything gets reflected, right? If the currency, if the current account goes up, if the fiscal deficit increases, inflation goes up, if the FDI flows negative, it will impact the currency. So if you look at India's currency in the last 2 years, right, the volatility of that has been the bottom decile compared to all the currencies, emerging as well as developed markets. So that shows that there is a stability. And when you have macro stability and the strong foundation, I think then you can have a much more sustainable growth. And if the economy continues to do well, and that's what we believe, there are other factors also in terms of what's happening in India geopolitically, how India is now emerging as a manufacturing hub thanks to people trying to move away from China. If you add that up, then we're still in the long journey in terms of where this economy could move over the next, say, 5 years, 10 years. And given that, I would say that the market is not as expensive. If you really believe in that, then this is not a time where you would want to, get down on the train, right? So one is to still be invested. At the same time, one is to be aware that there is risk. There are potential risks in the market where there has been exuberance. One has to stay away from that. If you do that, right, then there is enough opportunity even in this market to make long-term good returns from here, I would say.
Vishal, do you like to add to that? What is your advice to the investor given the current state of markets, Indian markets?
Okay, I think Mahesh has covered a lot of ground. But talking about the advice to investors, I think my first advice would be to keep your expectations realistic. Because coming into the market like this, and I think we see a lot of such behavior where your expectations are now just too unrealistic. There was a time when achieving double-digit return on a portfolio level was considered very healthy because the objective was to beat inflation, and 7-8% inflation, 10-12% returns was very more than healthy. Today, if people are coming in and comparing, my neighbor got 60% return and therefore I need to target 80% return, you're going to be disappointed. So if you keep your expectations realistic, go back to fundamentals saying, what am I really trying to do? And in the long term, my objective is to beat inflation, benefit from the India growth story, then that will not disappoint you. The second is, to do that, you have to display patience and perseverance. So even if there are short-term wobbles, which can always happen, with any such move that we've seen in the last 5 years, Most of, I think, the audience would have heard enough people saying, mean reversion, whatever else, other theories that you look at statistically will say there has to be a correction, this is unreal. But even if that were to happen, keep the patience, keep the perseverance, and look at the longer term picture. Just adding to what Mahesh talked about, which is the macro story, if I were to look at a few other benefits that we are seeing right now. So yes, the macro story is looking fabulous. Many of us have not seen this type of a structural story for India for a long time, in our careers at least. In addition, now you've got liquidity, which is more domestic-led, not FII dependent. So domestic liquidity and the sort of, the J-curve effect that I talked about earlier, that looks quite stable, quite real. In addition, you have the FII, FPI, which could also add. Keep in mind, at least traditionally, every time the US dollar has weakened, emerging markets have benefited. We are still an emerging market.
Correct.
So currency strength on a relative, stability, forget strength, even stability for the rupee versus the dollar, that can itself add a fair amount of thing flow. So liquidity is still quite strong. One keeps worrying about this move being unreal, but then it's very difficult to see what would cause a significant correction, because every time a small correction starts, there's enough liquidity to sort of pull it back. So corrections have been shallow. So if one just goes with the fact that, look, among the alternatives that I have, the India macro, the fact that liquidity is still quite strong, there are still upsides to this, is a very big, very good story. Add to that, often we compare long-term Ps and say, oh, this P is very high. Now, going back to basics, this is all derived out of DCF models. DCF models have a discounting rate. If India rate comes down, you can actually afford a higher P. That could be another argument. In a structurally lower interest rate environment, you can't really compare the P of an economy where, interest rates are 12% and a P of an economy where interest rates are 6%. So we have to adjust for some of these factors. And therefore, yes, even if there are pockets of higher than normal sort of valuations, there are still enough opportunities for stock pickers, for managers, and at least at a macro level, enough room to make wealth as a far better probability than many other places.
I would like to add one more dimension, taking up from Vishal just talked about DCF, so that's a tool in our backyard. So without taking a call on the market, one of the trends which I would want to highlight is related to interest rates. So when interest rates move up, it impacts negatively long duration assets. And when interest rates fall, they, of course, positively impact long duration assets, and vice versa. So without taking a call on the market, if you just were to look at the market structure, we have seen high growth companies significantly underperform low growth companies in the last 1 to 2 years, largely because we were seeing a very high interest rate environment in the last 2 years, which is conducive for low growth stocks versus high growth ones. But now, since interest rates have once again begun their descent, and the markets have started already rewarding high growth companies, I think within the overall market, that's an area which could appear interesting.
Okay. Here, Gokumar, I'd like to ask, the latest reports that have come from the US, they seem to be very promising. Their markets are reaching record highs. And so the fear that this rate cut had been induced because of the fear of recession, do you think that the Indian markets no longer need to fear that kind of reaction, and that it is going to be positive for a longer period of time for the Indian market?
Yeah, the way that we need to think about is that when you look at Indian markets, last 3.5 years, we are very linear in the sense that we always looked at and said, markets looks very linear in terms of the way the market performance were. One thing I'd like to make a point is market will remain volatile. I think that's a reality of the market. I think a lot of people came to markets, they still believe that markets will behave linear. The linearity in the markets is a false theory. The markets tend to be volatile. I think whatever you have, macros being very good, all things are fair, but market tend to be volatile. I think that's one thing. And what we need to do is that make sure that investors has to invest for a long period of time, make sure that they have to go through that volatility in their portfolios. Second point of yours, in terms of US Fed, yes, the correction happened. Globally, you have seen most of the central banks are cutting rates. But the India story is quite different in that sense. I'm not saying that India is completely decoupled, but if you look at the last 6 quarters in terms of the flow, the markets flowed because of the domestic flows. So in that sense, decoupling theory can come back and speak about saying that India is completely decoupled in terms of the FDI flows, FI flows. So that's the answer here, saying that India can now stand alone. Look at the primary markets today. It's crazy, right? Look at the amount of subscription happens. In our days, we used to go to Singapore and Hong Kong to market an IPO. I don't think today, no investment bankers go to Singapore and IPO. They go to domestic institutions like us. And there is a huge amount of fight in terms of allocation. And day when the DRHP is filed, I think the issue gets closed. From my institutional perspective, I think, just imagine 5 years back, we all used to fly and sit in Singapore and Hong Kong and do roadshows. And that is gone completely. Just imagine such a large IPO, which is, I can name it Bajaj Home Finance. Look at the money they generate, some 3.5 lakh crores of money. I think, imagine this is a pure domestic money came to the markets. I think there is enough liquidity in the system to sustain this market. That's my point.
All right. Mahesh, you would like
No,
to...
I was just saying, I mean, while there is a fear about US recession, honestly, but just to go, normally what has happened whenever the rate cuts have happened earlier, right? They have been triggered by some crisis, whether it was during the 2000, right, when it was the dot-com bust,
yes.
then the global financial crisis. This time around the rate cut, that's what people normally say. Historically, if you look at, after the rate cut, markets have given negative returns. Normally, you would expect the rate cuts have started, right? Correct. In the last 3 instances. But this time around, it's a bit different. It's not triggered by any kind of crisis. It is basically like calibrated move to really bring down the growth which is there, right? In fact, global economic growth has been very strong. Even US also, this year, if you look at, the growth has been actually surprised and it's been revised upwards. Because of high inflation and the labor market, which was very, very tight, which has now started to ease off. Okay, now we are seeing that the Fed is cutting interest rates. So I think it will be a soft landing. Okay, the growth will be weak, right? US growth and even global growth will be weak because China, which is a large driver, is now struggling to grow. So that in a scenario is not a bad environment for India, right? Where it's not a recession, right? The growth is slowing down, which means that the pressure on commodities and this thing is lower because India is a net importer of commodities, right? So that is good for our economy. And relatively, India is less dependent. If you look at the beta of India vis-a-vis the global growth, right? India has the lowest dependence amongst lot of the other emerging markets. So we should not, our growth is more driven by domestic factors. So in a way that becomes a good scenario, right? Where there is global liquidity, which is the rates are going down. They're looking at a market to invest where the growth is better. Okay, there is no crisis, okay, because then there's a risk off. When there's a risk off, everybody pulls out money, irrespective of this, and India would also get impacted. So I think in that scenario, I think we should be in a favorable situation, right? The rate cuts, what we are seeing, no recession really, probability of being low, but a slower global growth.
All right. Another question that I'd like to ask here is, so the domestic investor, so to say, doesn't seem to need any encouragement in participating right now. They seem to have owned the India growth story. What about the NRIs, the Indians who are abroad? Is there a possibility of drawing them back to the Indian markets, or are they already poised to do so? Vishal, would you like to answer that?
I think the NRI community has always been a large part of, I don't know if I'm audible, but I think they've always been a large part of our market, and that will continue. One of the, I guess, realities that we must also face is that with cross-border movement of capital, higher KYC norms, reporting requirements, etc., sometimes it may seem like the movement of money may get a bit more difficult. So if you're a US person, even if you want to access Indian mutual funds because they have great track record and a lot of variety, etc., there may be some constraints given just where your jurisdiction is. But having said that, I think access to India, if you are a person of Indian origin, OCI, NRI, etc., I think that there are enough and more channels available, whether it is directly investing with any of our funds, or it is investing through a global offshore fund, which then feeds into the Indian market, or now the new Gift City setup, which is becoming more and more interesting, more and more available for investors. But I would go beyond just the Indian community. I think we should see and expect to see a lot of global capital participate, not just now any longer in equity markets, but also on the debt market side, because the inclusion of India in the emerging market bond index is a significant
Correct.
development.
Correct.
And even if you were to just replicate the weight of India in that index, you're already talking about $20–30 billion of additional flows. And structurally this is very important, because as a growing economy, we need capital. And there is domestic capital, there is domestic investment that can happen, but we need a lot more. And therefore, opening up all sources of capital, including both on equity and debt side, is going to be important. I think inclusion in the bond market index, in a higher weight in the emerging market index. I think we just crossed China in the weight in the emerging market index on equity. I think these are great signs. The better we perform, the more the capital flow, and therefore that can help us fuel our need for growth capital in general.
Mahesh,
Let me just add, because I'll tell you from my experience, because I was a couple of weeks back, I was traveling, along with the Gift City, delegation, right, in Scandinavia. And there we met a lot of NRIs, also other investors, global investors. The real challenge for foreign investors to investing into it directly, I mean, you can invest to the offshore fund, that's one way to look at it. But offshore fund, in fact, investing into it direct in India fund is much better than offshore, because they have restrictions in terms of ownership of what you have and the taxation. So I think the biggest challenge was in terms of the taxation, right? And in terms of, for NRIs, it was the PAN, this thing number, and if you don't, I mean, they don't have, right? I mean, unless you have also Indian citizenship. So I think the Gift City route becomes a very good way for vehicle for, and they want to invest, because all NRIs, they know India better, right? And they have that affinity, right? They want to have enough ownership, into Indian equities. And I think the Gift City route is a wonderful way for NRIs to come in. There is zero taxation over there, right? You don't require a PAN card. You can directly come in over there, and through a feeder fund, you can participate in any of the funds, which are there domestically. So we have also recently launched this thing, a feeder fund, but I think that could be a great route for investors, NRIs, to participate seamlessly and benefit from the India opportunity.
Okay, one last question before we invite the audience questions. The recent taxation changes that have happened in mutual funds, both the equity and debt. Do you think, Vinay, this is to you, do you think that this is like to impact the investment decisions?
I don't think so at this point of time. Tax is at the top of mind of any investor. Every investor is generating a hell lot of returns at this point of time, but of course, over a longer period of time, we would need a stable taxation structure, be it equity, fixed income, or other asset classes, to ensure that we have investors who remain invested for a long period of time. So just to give you an example, Warren Buffett, in one of his recent interactions, highlighted that he reduced his Apple position just because he feared that the government might raise taxes and reduce his overall returns. So I think those kind of things should ideally be avoided. A stable taxation and a moderate taxation is always welcome. At this point of time, I don't think so we are over-taxed on equity. So it's a great tax structure. Hope we have a continuation of the same.
Why I asked this question was because for Indians, typically, tax has been a great incentive for any kind of saving or investment, right? So maybe Gopamar, you'd like to answer that. Do you think that taxation is going to impact the investment decisions going forward?
I don't think so. I do agree with my panel. I think what is happening is that if you, Vichal spoke about when we joined, we took an LIC policy.
Can you just speak up, please?
When we joined our workforce way back 30 years back, we all took LIC policy because it gave me a tax break. I think most of the products that point of was taken because there was a tax break, including ELSs. A lot of products were sold because of that. Good thing about now is that I think government is very clear in terms of the regime of taxation, in terms of not differentiating between asset classes, bringing the uniformity. I think that's a good call. The idea is that from here next what? That's the question we need to ask. Yes, I don't think there is any impact at the moment of time in terms of what changes has happened this time. I think, in fact, as Chirag speaks about, is that there were enough money people made and they were okay to pay the taxes. The problem is when the returns goes down and what will be that conversation. I think that's very important. We've seen a couple of negative impact on the corporates, for example. They lost some indexation benefits. You would have seen in the papers, I think there is some heartburns around that. But having said that, I think people accept this tax structure because we're part of this country, we need to pay taxes. I think people go forward. More importantly, the way I think about selecting products is that you need to look at the merit of the product first. And then you understand and say that what is the impact of tax loss on this product in terms of returns. I think that's what we need to think about when we advise to a customer in terms of what product and what asset allocation you're trying to do. Not thinking from an angle that, oh, it's so much taxes to pay, hence I will not do this. I think that's not a right approach. That's what my perspective is on how we should look at the tax structures at the moment of time.
Correct. So in that sense, the new regime, tax regime, that is a good way of decoupling the investment from the taxation incentive, right? Vishal, you'd like to add to that?
Yeah, so I think, when investors look at comparing options, I would think, post-tax is always built in. So when I'm comparing an option to believe that I'm looking at only nominal rate and not post-tax rate, I think that is probably not true. So you're always comparing on a post-tax basis. I'm sure over here as well, you look at what's the taxable tax status of the investor before making a suggestion or recommendation. So it is always on a post-tax basis. Now, once that is established, that you're comparing apples to apples, I think what we really need are just 2-3 simple things. One, it should be equitable, right? So if you're offering a benefit somewhere, you should offer it across products. And to that extent, I think if we had a benefit, it's been taken away, it's only fair that, we are treated in a similar manner. We'd love for the benefits to continue, of course, but if it is apple to apple, I think that's only fair in the nature of competition. Second is, it should be stable, because, if it keeps changing very often, then before I figure out what's going on, it's changed again. And third, ideally, it should not be retrospective. So if I made a decision based on something and it now hurts me, I think that always impacts confidence. So I think if these things were largely not to happen, as in, if it's not retrospective, it's fair for everyone, it's equitable, and it is stable largely, then I think as a product provider, as an asset class, it's only fair that we compete on merit, not just based on tax benefits. And I think the move and the direction clearly seems to be in that direction.
Correct. Okay, I think with that we can open the floor to questions, right? Your voice is not...
Hello. Yeah, there are quite a number of questions which is already on the screen, and I think Bharat Bhai has actually reached to the other Hayat. So I think by the time these questions are done, and if he is able to reach, we can have 10 minutes from him also as a closing remark for the session. So maybe 1 or 2 questions you answer, then we can have...
Would you like me to pick, or would you want to pick?
I think the questions are in front of you. You can ask them, and whoever wants to give quick and short answers, please do.
let's go with which sector will be performing best in 3 to 5 years? Who would like to answer that question? Mahesh?
No, I think again, when again you have to look at, I mean, we have seen a lot of sectors do well. In fact, this rally, what we have seen, right, has seen multiple sectors do well, right, compared to what it was pre-COVID. Whether it is the real estate sector, whether it is the investment sector, the capital goods sector, right, the auto sector, everything has participated. But if you look at slightly more longer term, right, what is the structural story in India, right? So we think the structural story in India is that as India is at a cusp where your per capita income, right, is at $2,500, $2,600, and with the growth in GDP, I think we think that, and looking at the demographics of India, right, which is a young population, okay, which is aspirational, okay, which wants to go in for brands, and looking at premiumization, then the consumption story, the discretionary consumption, right, okay, because once you hit that point, that inflection point of per capita GDP, the amount of money you would spend on discretionary consumption, whether it is aspirational goods, whether it is on spending out retail, consumer durables, footwear, apparel. So that is going to be a structural story for India, which we think will last for the next, say, couple of decades or so, right? And given that outlook, I would say that's a sector, I think, which can be much more stable and which you can bet over the next 5 years. Also, okay, what we've seen is that, as I said, there are, I mean, a lot of great companies, okay, which are coming into the consumer space, okay, into the new to the market. Also, if you look at most of the companies are consumer facing, and that also provides opportunity to really participate in some of these new growth areas. So I think that, to me, looks to be a great way to play that sector, which has the demographic dividend in place to play the whole young, the new millenniums and the aspirational of new India, okay, which will drive the growth in that sector for a long period of time.
What I would think of is one of the sectors which is related to consumption, but a little different, is healthcare. Healthcare as a sector is now pretty well spread out between domestic formulators, hospitals, CDMO companies, etc. This is a sector which looks very interesting, and we think that over the next 3 to 5 year period, the likelihood of this sector doing well is much higher.
All right, the next question I think I'll pick is, which is very timely, of course. There has been a flood of NFOs with a bent towards sectoral and thematic bent. So do you think, will it not create negative experience for the investors? Who would like to answer that? Kumar.
Yes, I am the culprit. I did the thematic.
Yes, go ahead, please.
I have a lesser comment on the sectoral funds. I can tell you from our view perspective, why do we bring themes? We bought 2 themes since last 1.5 years. What we look at the themes which is multi-decadal, very closer to the economy is what we do. We don't do themes which is off. We don't do any narrow themes. So if you look at our both manufacturing as well as consumption, is a very broad-based area. What we think about is that how do you approach this theme in the market, and that's how we build that portfolio. So in that sense, we are much more diversified. If you look at the benchmark as well as the portfolio, it is a very well balanced portfolio in terms of the portfolio construction itself. So that's how we approach these themes. Coming to sectorials, we don't do sectoral funds because our view is that you will raise money, because in 2007 we had all pharma funds, we had banking funds, we had auto funds. You ask me whatever sectoral funds we had, but it has one negative, is that once the sectoral theme goes off, when initially we'll do a great NFO where we'll raise 1,000+ crores, but when the whole thing goes off, you end up with a smaller AUM, and it becomes very difficult to manage. So that's how we do believe that we as a founders, we don't do sectoral funds. If at all we have to do, we will do it through index funds. I think that's what we try to do in terms of our approach towards themes, thematic versus sectorials.
I think Mr. Bharat Shah is with us. Yes.
So, Bharat Bhai is there. You can just have a seat. Can we give a big round to Bharat Bhai? one of the most senior most personality and the wisdom of over 35 years. So we will request Bharat Bhai to please share your views about the markets and
Wealth creation.
and
Maybe the
what
wealth
should
creation
help.
and the markets, yes.
Yeah. Now over to you for next 7 to 10 minutes, 7, 8 minutes, whatever.
So what are your views on the current Indian market situation? Where are we headed from here? And secondly, what is the wealth creation advice? Given the current state of Indian markets, what is the wealth creation advice for investors?
Hello. The voice is coming at the back?
Yes, that's fine.
Well, my view is not altered in last several years. First of all, apologies. I went to wrong Hyatt Regency, and therefore it has been 1.5 hour trip back again. So apologies for that. And I have a surgery tomorrow morning, so I have to leave at 6 o'clock. So I'll be only there for half an hour. So pardon me for this. So I have to leave at 6 to catch my flight at 8 o'clock. I believe we as a country are at a defining moment. Our economy is at a defining moment. So are our businesses and therefore the markets. In my 37 years of observing and investing in Indian markets, I cannot recall a single other previous period when a set of fortuitous circumstances and set of conditionalities which have come to occupy, which make our situation so distinguished as it is today. And over 37 years, I've been witness to some 6 cycles, some of them truly violent ones. This one is opposite, where it is obdurately stable, even if a lot of people are wishing, willing, conjecturing that when will markets actually come down. And I suspect more people expect that, and more money which is lying on the sideline, more stubborn the markets are likely to be in seeking to come down. But from that lighter note, coming to, I feel huge fundamental changes have occurred in the character of our economy, indeed in the capability of our businesses, and indeed the strength and capability of entrepreneurs running many businesses in this country. Markets in the past reflected economy which was kind of chaotic. Usually politics dominated economic outcomes for the economy, and therefore policy framework also was wavering, and therefore markets reflected that reality simply because economy was never in a predictable, strong, long-term, any view kind of a situation. Because economy did not have that predictability, the businesses also were in a state of flux all the time. And because that was the case, their market values also reflected that uncertainty. And because of that, the markets themselves always were in a state of flux, where rise phase of a market at any point of time was rather narrow and sharp, while declines were deep and prolonged ones and very, very painful ones. Therefore, structurally, market behavior also was such that an attempt to take away profits before profits disappear. And therefore, that short-term mentality that was endemic in the market, you can't find fault with the investors for that, because that's how the economic reality of the country was for decades in the way economy and the businesses were. What has changed? Number of things. First and foremost, I think a large number of deep and interconnected reforms have happened. When reforms are few and far between, and they are not particularly biting ones, the outcome at best can only be arithmetic sum total of whatever has to happen out of those reforms. But when reforms are many, they are deep, and they are interconnected, then they become an ecosystem of their own. An ecosystem allows growth to be a force multiplier rather than growth additive. And therefore, the growth today has acquired a force of its own because all the different parts of the economy are doing well. Such a set of reforms builds an economy, builds businesses, which acquire not only growth salience, but also growth pervasiveness. By growth salience, what I mean is that the growth rate not only is distinguished compared to India's own past, but it is, I think, going to be much higher than virtually any part of the world anywhere around of any comparable kind of economy. The growth pervasiveness is even more important. And there are three important factors in that. The predictability of growth, durability of the growth, and resilience of the growth rate. And all three are very vital. When we talk about predictability, we are saying that it is not that growth is an outcome that occurs, but it is predictable that a certain kind of growth will occur. When two outcomes occur, when an outcome occurs and without predictability that it will occur, and the other outcome occurs with the exactly same impact and the size of the outcome, but with a predictability that it will happen, the second one will have a far, far higher value than the first one. Similarly, durability. When growth is durable for a longer period of time, then it acquires a greater character and therefore a greater value compared to a similar growth rate, but for a shorter period of time during which that growth occurs. Third, the resilience, where earlier the structure and the character of economy was weak and not deep enough, and the policy framework was unpredictable and variable. The ability of the businesses to deal with the challenges in the environment were limited. The ideal example I can give is from February 22, the Ukraine and Russia war is going on. It's now 2.5 years. And last year, while America has been in trouble, Europe has been in trouble, Germany has shown deep weakness. So is the case with Japan and Korea and China. India grew at the rate of 8.2%. That 8.2% growth rate was not an accident or a happenstance or a chance. It is because number of things we have done as a country, as an economy, to make us reach where we are, where rest of the world has been in trouble, but India grew at 8.2%. Therefore, ability of the businesses to deal with the challenges is a vital change which has occurred. Third very important thing that has changed is the capital efficiency or the character of the growth. Return on capital employed, return on equity, both have distinguished themselves over last few years. Indeed, for the first time, corporate India return on capital employed and return on equity stand at number 1 in the world. That trophy always belonged to America for decades, and therefore no surprise that American markets have been the blockbuster ones for decades, because one of the greatest indicators for the value creation is the capital efficiency and its pervasiveness. And America has always been at the helm of that league table. First time, India has occupied that medal as number 1 country in the world in corporate return on capital employed and return on equity. Second distinguishing aspect is that never before we have seen where lender balance sheets are so healthy and the borrower balance sheets are so healthy. Lender balance sheets have become healthy because of the cleanup that we have seen in 2020, 21 and part of 22. A lot of accumulated muck and dirt which got accumulated over 7, 8, 9 years finally had to be cleaned up during that phase, and therefore today Indian lender balance sheets are squeaky clean and among the best in the world. In terms of regulation of the lending sector, probably is distinguished as easily the best in the world. Not only our lenders are having the pristine balance sheet, regulation of our lending sector probably is unmatched anywhere in the world. Equally, borrower balance sheets are among the best in the world. 5 years back, before COVID hit, in 2019, debt equity ratio of Indian corporate segment was 0.8:1, 80 to 100. Today, after 5 years of relentless growth, despite two rude years of COVID, debt equity ratio has come down to half at 40:100. That when you combine with the fact that the cost of capital has declined, 10 years back, 11 years back, your best companies couldn't have borrowed at less than 12-13%. Your home loans would have costed you 14-15%. And today, the same home loans are available at 8.5 to 9%. And the best quality corporates are able to borrow at anywhere from 7.5 to 8%. These decline in cost of capital has not only impact on the profit and loss account of the businesses, but also has a deep impact on the valuation of the businesses, because any value of any income earning asset is intimately linked to the underlying cost of capital. When that declines, the value of the asset goes up. And therefore, it is not a surprise that valuations have shown a tendency to improve with all of these changes. Therefore, to summarize, our growth rate and capability and structural strength to deliver that growth rate has become elevated compared to any time in the past and compared to any other entity, any other country in the world. Secondly, not only our growth rate is going to be distinguished, but the pervasiveness of the growth rate in terms of durability, predictability, and resilience is unmatched again. And third, a very, very important indicator for value creation, capital efficiency has become the best in the world. Balance sheets are among the healthiest in the world, both of the lenders and borrowers. Cost of capital has also declined. Now, one major indicator for value creation in a business is an idea called economic value added. Economic value added is nothing but difference between capital efficiency and the cost of capital. Therefore, not only capital efficiency has risen, cost of capital has declined, and therefore economic value has expanded to a larger number. That economic value aided becoming larger, coupled with higher, sustained, durable, predictable growth is the foundation for why markets are what they are in India today. And as I said in the lighter way, but more people wish and more people desire, so long as there is so much of money which is still waiting to get in, so long as foreigners who have been selling and selling for more than 2 years and finally seem to have been exhausted by their large amount of selling and are finding that probably there is no other market which is really good and strong as India is, that money, for all you know, is waiting to come in drove. Last Friday, a single day, foreigners buying some 35,000 crores worth of stocks is an indication of that, waiting for something or waiting for Godot for too long, and finally they can't wait any longer and they've decided probably to come in. All of these are not to be treated with the usual lens of the past. The usual lens of the past was, market character was कि भागते भूत की लंगोट बराबर, कि जो मिल रहा है प्रॉफिट ले लो क्योंकि वो कब रहेगा और कब डिसअपियर हो जाएगा पता नहीं है. But that was in the past. I think investors are also learning that this market is different because the underlying businesses are becoming different. Businesses are different because they're developing greater character and capability and efficiency. Why that is happening? Because number of reforms have happened to enable the character and capability of the businesses. And therefore, when all of this combine together, that's where the things begin to change. For decades, last decade, in many interactions with the foreigners, I said at some stage, India will become an independent market in its own right, and not as a part of some emerging market or ex-Japan Asia-Pac market or some BRICS economy or some such jumbled up acronyms that people are so fond of throwing. And for the first time, it is now beginning to look like a reality. India is already the highest valued market in the world. And I think day is not very far off when it will be the third most valued market in the world. And I think China is going to take a faster for India to exceed China's market cap. And while it will take much longer for India to overcome the size of economy of China, but a market cap of India probably will come ahead of China much, much faster than the time it will take to exceed the size of economy of China. That is the kind of future that we are staring at. That's not to say that markets will not be volatile, that things will not happen. Markets have always been volatile. They were volatile 2 centuries back, last decade, last year, current year, next decade, next century. Markets will always be volatile. Volatility is an intrinsic characteristic of the market. But volatility and impatience stemming from lack of belief about future is one kind of volatility. And volatility which is normal, where time to time people take a view to step aside or step in, and a temporary pausing of their activity or engagement with the market is a very different kind of a market. We are today, in my opinion, into that kind of a market. And therefore, we are at a cusp of one of the greatest economic expansions that this country has ever witnessed. Not only the size and the scale will be distinguished, the character and the quality of that is distinguished too. And very importantly, durability and predictability of that is going to be another distinguishing aspect. And therefore, I think it's a dream kind of an opportunity, despite intermittent volatility, occasional skirmishes, and hopefully not, but probably once in a while, some kind of a modicum of violence also would occur. But if you stay through that and remain patient with the right thing in a right way, I think we are at a cusp of one of the greatest phases of value creation. My only personal desire is, if I were 20 years younger, probably it will give me 20 years greater opportunity to compound and compound, but that were not to be. And therefore I probably wish that I hopefully will live long enough to enjoy that compounding phase for a longer phase. But this is a market of an incredible variety. So I'll stop here with those initial remarks.
I think that was very well encapsulated, the India growth story, the market growth story. I think that those are words of wisdom for the investors, and they can be, I think, rest assured that it is a long-term growth story, and they can invest accordingly. Kanak.
Thank you so much, Bharat Bhai. I think we were discussing and you have just put a stronger nail. Now the things are much better. And I think that is the reason we are sure that you will be living more than 20 years, 25 years. Otherwise, he is going to North Pole and the places where most of us cannot dream of even. So I think that's the secret.
Work as hard as before, maybe an hour longer. I continue to work at 16 hours a day, and I continue to read 9 or 10 hours a day, every day. And I hope that this market, this economy will continue to energize, because that opportunity is so energizing.
Thank you so much. Thank you so much. Thank you so much, everyone. Can we have a big round applause for all the panel members? We'll request you to please stay here. I'll request some of our, please stay here, Kumarji, just have to start with, I'll request Gopi Kishan Agarwalji to please come up
No, also, a lot of time people are. Hello? Hello, is the voice coming? Hello? Yeah. All the time you keep hearing that markets have gone up too high, markets have become expensive. While it is factually correct to say that indices have gone up, there is no doubt about it. Indices have been scaling new highs without any question. But that's not the same thing as valuations have gone up too high. There may be, without any doubt, pockets of excess and pockets of aberration. Indeed, like in Delhi, a few days back, we read some small auto dealer seeking to raise some 10-12 crores, got probably his life's bonanza of some 1,000 or 2,000 crores worth of subscription. So those are clearly showing that there are too many enthusiastic people who seem to think that many of these participation are like free lottery and therefore they can benefit. But I would like to say that there is no systemic anomaly in the market today. Over 37 years, I have witnessed phenomena where 3 times exchanges have closed down because exchanges could not clear their settlement. I'm not talking of brokers defaulting or individual clients defaulting. Exchanges went into a state of freeze. But today, our systems are easily among the best in the world. Our margin collection system, our digital network, on an online real-time basis, the markets are monitored. And therefore, while I'm aware that almost 99% of the activity in the future and option, mostly in options, unfortunately, rather than in futures, which is relatively more time and price adjustment exercise. But even if it is so, and many of them lose money, I'm not going to shed any tear for people who want to gamble, who do not understand, or who are treating it as a hobby or engagement or addiction and lose money. But system is not at a risk because system is maintained in a very, very healthy, real, solid way. And therefore, even these lot of concerns that people keep expressing that things are going out of line is actually not borne out by facts. We have also not seen aberrations where completely gutter kind of businesses and lousy kind of businesses acquire stratospheric kind of valuation. Therefore, even in terms of the health of the market, that situation is actually not out of shape. Market valuation, if you talk about, not that P multiple is a very good description of real valuation, but Nifty is just about 23 and a half times. Not very different from last 10-year average of Nifty. Therefore, indices have gone up, but a lot of other things have kept pace with the index. Mainly the earnings, but what is not revealed in the price earning multiple is things like that quality of the growth, the resilience of that growth, and the character of the balance sheet supporting that growth, and the synergistic nature of the growth that we have built it into the ecosystem. And which is why a very mathematical valuation of trying to compare that things are more expensive or less expensive, which even on a mathematical number is not particularly higher than the past, actually will be a mistaken way of trying to judge the direction of the market. But that said, time to time markets will correct, and a lot of businesses which are not really up to the mark or have a character to create the kind of value will also correct. And I don't think there should be any tear shed for that. But structurally things are sound, and a lot of good businesses will keep getting bigger, richer, more valuable, of a kind that we have not witnessed in the past. I'll just leave you with one last summary. If you take last 30-year picture and compare three most important economies of the world, India, America, and China, and compare the real dollar GDP growth rate of each of them along with the dollar returns of the market, in 30 years, America did about 4% GDP growth rate in dollar terms, nominal GDP growth rate. Markets did almost about 9.5% over 30 years period. 4% GDP growth rate, 9.5% reward in the marketplace. 5% plus greater reward per annum for 30 years compounded for superior quality, character, strength, and die-hard strong capitalist system of America. India, in the same period, did about 8.5% GDP growth rate in dollar terms and 8.5% market returns in dollar terms, like for like. No premium like America, where America enjoyed 5% per annum compounded premium. India got 0, but no discount either, like for like, 1 for 1. China, 13.5% GDP growth rate in that 30-year period. Incredible. Never again, I think it'll happen again. No country, in my opinion, is likely to produce that kind of a growth rate ever in the future, not even India. But look at the market returns, less than 1%, 12% discount per annum compounded over 30 years. That 5% premium, 0 for India, and minus 12 for China is basically what that quality is. Quality of growth, character of growth, durability of growth, predictability of growth, certainty of that growth, resilience of that growth, and the strength of the balance sheet. Many of these aspects is actually summarized into that plus 5%, 0 or minus 12%. Going ahead, I would say that India actually will do better both on the growth rate and for the first time the premium will emerge, which was 0. For America, that growth rate is unlikely to replicate at that 4%, and I think premium definitely will shrink. But America continues to remain a very important market and important country, even though a diminished one. China, on both of those, there is uncertainty. Growth rate certainty is unlikely to be ever recorded by anybody. Whether there will be any premium or discount or neutrality, time will tell. But India at least has got both the aces up the sleeve. And therefore, unless there is something significant which happens to the continuity of economic policy and the behavior and the resilience that the leadership has displayed for this country, if there is no significant or material change to this, I would say, barring more other normal factors that people worry about, sometimes oil prices, sometimes our very friendly neighbors who are very nice to us all the time, or geopolitical and many other challenges, but all these are solvable, manageable challenges. I think barring the leadership and continuity of the policy framework, I would say we are at a cusp of one of the greatest opportunities in this country. Thank you. I'll just stop.
Thank you so much, gentlemen. Thank you, everyone. We'll just invite you in next few minutes to give away. Thank you so much. Your bag is there. In the meantime, I'll just be seated for...